Rob, it is the 406th anniversary of the Second Defenestration of Prague. What are you doing today to celebrate?
Drinking some Czech beer, I guess.
Not throwing yourself out of a Parisian window, I guess. Began the 30 Years' War, one of the worst wars in the history of the world that nobody talks about. Also, where I learned the word defenestrate, and where you should all learn the word defenestrate. You know how there are like parts of high school that are indelibly like marked on my brain? I can still see the page in the modern European history textbook in AP European history when I was thinking about the defenestration of Prague. Anyway, that's not what we're here to talk about. We are talking about not Bohemian. I forget if it was Bohemians or who it was that got thrown out the window, but we're talking about inflation expectations being flown out the window. How about that for a segue? I've been all over the place dealing with President Raisi and all this other stuff this week. So Rob is really driving the podcast this week. And Rob, you wanted to respond a little bit to cousin Marco and the stuff that he said. But before we sort of get into your pushback on Marco's arguments, why don't you just lay out a little bit about what you're thinking and seeing about inflation right now? Because just for listeners' benefit, as we talked about last week, like we were very, very early on saying that we thought inflation was going to go higher. And then for the last month or two, I would say we've sort of been, okay, like inflation did go higher. What's going to go next? And I've been feeling, I'll speak for myself, I've been feeling uncertain about what's next. And it seems to me like you're now rounding into some degree of confidence about where we're going to go from here. So what are you seeing with inflation, and why is it so important, and why are we going to talk about it here today? And why, like a year from now, are we hopefully going to be talking about the May 23rd, 2024 podcast and how important it was?
Well, to start off, I want to clarify and say that I don't disagree with what Marco said. And I think that's an important starting point, because what Marco said is that demand growth in the US is slowing down and consumers are slowing down, and the YOLOing is coming off the boil, so to speak. And that's true. And the background to this is, I had my head down in earnings hell for several weeks, and spent the time after that kind of digesting what a lot of companies were saying, and then really digging into the macro numbers and getting updated, because I started to get concerned that our inflation thesis and our hawkish rate thesis was maybe wrong, because I am seeing clear evidence that the consumer is starting to slow down a bit. And there's really clear evidence that non-residential construction is really starting to slow down. So, I like to bash Nucor Steel every week. Stock can't get off its ass. Market's at a new high. What's Nucor Steel doing? Not a whole lot. But that's the canary in the coal mine for all of the, construction that's been happening and then has been driving a lot of demand in the U.S. economy. So that's the background coming into this. And my concern was, well, are we heading into a recession? Is inflation going to decrease? And I came away with a very different thesis, and I want to lay that out. And unusually, I'm going to tell the listeners what I'm going to say, and then I'm going to say it. So what I'm going to say is, there's a very real possibility that we've gone from the best of all worlds, which we've just experienced in the last 8 months. And by that, I mean declining inflation, super high demand growth, super high supercharged profits for business, and an AI investment frenzy, all happening at the same time. All of that is great for assets and risk prices. That we could be going from the best of all worlds to the worst of all worlds, which is slowing growth and accelerating inflation. And what does that mean for long-term U.S. Treasury yields? What does it mean for people's psychology? I think that's the key question. And what I want to talk about and lay out today are 3 related ideas. The first is that even as inflation has slowed down a bit, which we've talked about at length, inflation expectations are starting to become unhinged. And that's a big, big deal, as we'll talk about. long-term inflation expectations, that is. The second thing is, what is the Fed going to do if inflation expectations start to become unhinged? And I think this is something that no one is talking about. And if you look at what they say, they're going to come out with a sledgehammer. I think there's a very good probability of that. And that's not in the pricing. That's not in the expectations. And then number three is, what happens with market psychology? What happens with investor psychology if this begins to play out? And sort of the analogy that I like to think of is, do you remember the Star Wars prequels?
Of course.
Who am I asking?
What question is that?
Well, that's a rhetorical question. I assume most of our listeners, if they like listening to us every week, are dorky enough to know the basic plot. But one thing that always struck me about the Star Wars prequels was, of course, it's the story of a civilization going from, a period of relative prosperity and stability to a period of, upheaval and rebellion and breakdown. Is the whole notion of the prophecy that the Jedi are always talking about. And they say, it's been prophesied that a child will come to restore balance to the Force. And throughout the whole films, they assume that means it's going to be a new Jedi, a very powerful Jedi. And their baseline is, things are not good. Restoring balance to the Force means that, the Sith are going to be taken down a peg. But in reality, it was a new Sith to restore true balance. And that's a really nerdy way of saying that our baseline expectations about how good things are or what the overall environment is like change very slowly, and they're very anchored in the recent past. And I connect the Jedi and the Sith to 10-year US Treasury yields because if you look at how low Treasury yields are, if you look at the fact that even as no one really expects a recession, the Treasury yield curve is still inverted. What does that mean? It means people think the Fed has kind of got things under control, that we're going to pass through this period. Inflation is going to revert. As Marco said, it's going to revert back toward the mean. People will breathe a sigh of relief. It'll be off to the races. I think if the first two things that I, point out happen, there's going to be a realization that the Fed does not control many of these aspects of inflation. And we can talk about some very specific ones that I've prepared that are happening right now that really the Fed can do nothing about, and that are set to clobber us in 2024 and 2025. But the notion, that people are going to wake up and recognize the lack of control at the Fed, I think is a major risk that is not being reflected. And it's similar to, the last inflationary period. If you were to look at the 70s, very similar thing where inflation got worse and worse. And finally, you have this panic moment where, Volcker gets made head of the Fed. He comes out and signals he's going to be tough as nails. And do yields go down? No, yields go up because people realize, holy shit, it wasn't the Jedi after all. It was the Sith. Things are much, much different than my baseline expectation. So that's the big picture of the discussion I'd like to have.
Great. So you've given us the title of the podcast already, which will be Darth Fed. I'm really looking forward to putting that on the podcast titles. A brief note on the prequel. The prequels were so disappointing because it should have been a story about the decline of civilization, and it turned into sort of a weird amalgamation of Helen of Troy and like a soap opera. Like instead of the end of civilization, it all becomes about Padme and about Anakin and not about sort of the larger societal forces at work. So maybe Denis Villeneuve will make Dune 3 and then he will move on and fix the Star Wars franchise after it's been so obliterated. Anyway, we don't need to go down this rabbit hole. Why? Well, tell us about, because I was shocked when you sort of put this data on the Knowledge platform. Let's start with showing you why we think inflation expectations are unhinged. What are you seeing that makes you think that the average consumer thinks that inflation is going to go up from here?
This has been a topic that has been in the news because consumer sentiment is so bad. And people are talking about this in relation to the election. Why are people so unhappy? And inflation and blaming inflation and feeling the pinch of inflation is clearly a major factor in this. But if you look at the data, so there's a few different ways of measuring inflation expectations. None of them are perfect. Some people, we don't have to get into it, but some people measure by comparing tips against treasuries, which has all sorts of problems. And it's not a great way to do it. But probably the most direct way is the University of Michigan Consumer Survey data, which basically just asks every month, what do you expect about this, and this? And that data has been really interesting because even as inflation itself has decelerated from the very high levels of a year ago, inflation expectations have not really improved. So inflation expectations are sort of in the mid 2% range for a long time. And then since 2021, they've bopped around between 2.8% and 3.1%, very stubbornly. And the most recent data has shown them accelerating a little bit within that range. So the median respondent to the survey now expects 5 to 10 year long-term inflation to be 3.1%, which is equal to the highest it's ever been. So that alone is very interesting because expectations are moving one way, even as the data is turning another way. And I think that reflects some of those underlying factors. The very shocking thing is if you look, the number I just cited is the median respondent. If you look at the average respondent to the same survey, the data looks pretty similar, but in the most recent result for for May, the average respondent expects 5.3% inflation over a 5 to 10 year period, so long-term inflation. 5.3%. That is by far higher than any reading that we've gotten in the last couple decades. Like you have to go back to the 80s. We almost got there in 2008 when commodities were going crazy and oil prices were going to the moon. So 5.3%. So something is becoming unhinged there. And just mathematically, what it tells us also is that if the spread between the median and the average is widening like that, and it is wider than it's really ever been, then that tells you that there's some segment of the respondents that are giving very extreme answers, more than usual. There's some segment of people who are saying, 6, 7, 8% inflation. And that's really concerning. That's what the Fed, forget about, within the cycle and it's temporary or team transient, whatever. The thing that matters is inflation expectations. And anyone in the Fed will tell you this. And that data is really moving in the wrong direction.
Why is everybody saying that consumer demand is going down? Like I'm looking at this because I've been thinking about helicopters in Iran all week, and I went to look at consumer spending on the U.S. government. What is it, BEA or whatever? Bureau of Economic Analysis, and it's like consumer spending is up 0.8% March 24, up 0.8% February 2024. There was a stagnant reading in January, but it looks to me like consumer spending is still going up. But what am I missing here?
No, it's still going up. It's just going up at a slower rate. I think, as Marco said, no one expects a big recession. The expectation is just consumer demand has been absolutely balls to the wall crazy, and now it's calming down a little bit. And that's, what the most recent data shows is that you are getting a little bit of a moderation in that demand.
No one expects the Spanish Inquisition, Rob. No one. Well, I guess the other thing to say is, it's tough dealing with averages versus median. So what could it be that like a very small number of respondents are thinking this? Like, how do you differentiate this from a Looney Tune out there thing pulling the average up versus is this a real sort of steady drumbeat that you're expecting to get bigger over time?
Well, yeah, it is a Looney Tune average because that's the definition of extremes, right? So you have the extremes of respondents are getting wider. I think that's what you can just conclude from the math of comparing the median and the average. So how much credence do you give an extreme response? I think that's a valid question. But the perhaps bigger issue is, this is, as we say all the time, it's not about what's already happened, it's what's going to happen. So putting all these things together, do things go higher or lower from here? And if you look at some of these drivers that we can talk about, freight, food, housing, there's reason to believe that some of these things are going to accelerate inflation in the next couple of months, next couple of quarters. And if that happens, and you're already starting with the median number at the high end of its range, the issue is that the Fed can no longer say what it just said in the meeting minutes for the most recent meeting that actually came out before this data, where they said inflation expectations appear to remain well anchored. And that language is going to remain exactly the same until there's an emergency, because that is the bombshell language. As soon as that language changes, then it's a big deal, because that means everything that the Fed has been working for the last, I don't even know how many years. That's the Fed's mandate, to keep inflation expectations within range. And if they start worrying about that, then all bets are off.
Yeah, and I mean, so much what we're talking about right now is psychology. So it's almost divorced. I mean, it's not divorced from the actual data, but it's about what people are anticipating the data is going to be. And this sort of gets into, the current inflation prints that have still been hotter than the U.S. government wants. We're talking about it's a year-on-year comparison. So we're talking about it compared to 12 months ago. So I don't know if you experienced this, but when I'm talking to sort of normal people or listening to normal people talk, people are still complaining about high prices, because it's not like prices have declined in any meaningful way. It's just that they went up a huge chunk, and now they're going up more than they're used to them going up since 2008, or since the last time we had sort of meaningful inflation. It also goes back to this thing we talked about a couple weeks ago, the hedonic treadmill that I've been thinking about, and about how I remember that Kahneman and Tversky article about how people are more upset about losing $50 than they are about gaining $50. Because I was reading an article on the National Bureau of Economic Research. It had a bunch of authors, but we'll put a link in the show notes. And it talked about how wage growth in the United States from 2020 to 2023 is actually in favor of low-income earners, and that it's actually eliminated 1/3 of the rise in wage inequality over 1979 to 2019. The decline in inequality in the United States has gotten so apparent that I've purged it from my slides when I'm giving presentations. I used to lead with U.S. wealth inequality, and now I don't. I have to lead with U.S. energy independence. All of which is to say, like, I feel like the rejoinder here is, yeah, but like real incomes are up. People are making more money. The YOLO economy has more room to run because there's more wages in the back pocket of these people than there ever has been before. And I think, I don't know, for me, that goes back to, yeah, but people are more upset about losing the $50 on inflation than they are about gaining the $50 in their wages. And it's also not clear the wages are making up for the inflation increase on the back of it, which is a way of backing into, you mentioned you were in earnings hell. Was there anything in earnings that you felt like corroborated this? Like, were you seeing companies sort of thinking or saying the same things, or are they sort of in Alice in Wonderland, Goldilocks land still?
Companies don't usually comment on inflation expectations per se, but all companies are in their own Alice in Wonderland, La La Land, and that's because they have very different incentives from you and me. You and I, and most of our listeners, just want to understand the truth. Companies have to tell you what they think you want to hear and what's going to improve their pay packages. That's basically the constraints around which they talk about stuff. So, getting to the company side, one of the things, if you really spend a lot of time looking at individual companies, and we could talk about one, right? Just as an example, because this is all very high level. Let's talk about Williams and Sonoma, Pottery Barn, right? So they just reported earnings yesterday. They're a good representative of this because Williams and Sonoma, their revenues were down because people have been buying less furniture and all of those durables haven't been particularly strong, but their margins have been way up in large part because freight costs have collapsed. So their profits were up substantially year over year. And the company, just like, and I don't mean to pick on Williams and Sonoma, like they're a perfectly good company. This isn't, bashing them. But if you look at most companies, and we talked about this last week, about how Wall Street typically takes some number and extrapolates it forward. If it's going up and to the right, they say, if it continues going up and to the right, then 3 years from now, this is what it looks like. And of course, it doesn't work that way, but that's what people are doing right now with the margins of these companies. So Williams and Sonoma, just to take those numbers as a specific example, Williams and Sonoma historically was a business that did about 8 to 10% operating margins. So that's operating profit divided by revenue. Not to get too, numerical here, but this is important. 8 to 10%, that's good. That's fine. That's their business. In the last 2 years, they did 16 and change and 17%. Last year and this year, 17 and then 16 and change. Wall Street has them doing 17% next year and 17% the year following. A big part of why they're at 16% is exactly what we just said, because freight costs just collapsed and inflation and prices are pretty sticky. So Williams Sonoma, Pottery Barn, all of these companies have been making bank. Their profit margins have been huge. I like to pick on Chili's a lot. Another example, when we can talk about food, Chili's is a shitty business. Unlike Williams and Sonoma, they barely make any money, but their profits have been up a lot year over year because the prices of chicken collapsed in 2023, but they didn't cut their prices to consumers. So, you don't need a business school degree to know that your profits are going to go up if your costs are collapsing and your revenues are pretty stable. So, that is the takeaway from the earnings season that I got with a lot of these companies is companies have just enjoyed extraordinary margins and profits, and no company, no management team ever comes out and says, well, things have been really good, but it's not because we're just really good at our jobs. It's because the environment has been uniquely good for everyone, and we don't expect it to last. No company's ever said that, ever. It's always, wow, I really have to congratulate the team. They're doing an excellent job. We're executing so well. Look at how much our margins are up. We expect this to be about, the same benefit throughout the rest of this year. And that's why Wall Street has Williams and Sonoma making 17% profit margins next year and the year after that, because they say, oh, that's great. Wow, you guys are killing it. The execution is finally, after all these years, it's paying off.
It's funny. I Googled Williams and Sonoma while you were talking because I just wanted to look at their stock price and fool around. And that the sponsored tab with the suggested things that you could buy from Williams and Sonoma that comes up when you Google it. One of the first things for me was an entire wheel of Parmesan cheese, which you can have for $2,999.95, exclusive only at Williams and Sonoma. So hot diggity, they're getting in the cheese business. Anything else you want to say on that before we talk about how the Fed has responded to this change in the data?
Well, the only thing to say to that is, I'm sort of going on and on about cheese and Williams and Sonoma and chicken wings and stuff. But when you look at your stock portfolio, this is a big, big factor. And people are looking at these businesses and assuming that this continues, and it's a major risk to asset values. That it's not about, you don't need a recession, you don't need the consumer to have some crash or something. All you need is profit margins to start reverting back toward what they were historically as these waves kind of circle back to where they were before, and you have a major profit recession for business, and that's a big deal for stocks.
Well, and so, I mean, I think you're going to say that's a big deal for stocks. Probably how the Fed is going to react to this is going to be a big deal for bonds. So tell us about Philip Jefferson and what you're seeing from the Fed.
Yeah, so we talked about inflation expectations. How is the Fed likely to respond? And why do I make such a big deal about this? Because no one talks about inflation expectations. Everyone just cites the number and what is it doing this month and how's it year over year and blah, blah, blah. Why are they so important? They're so important because, as I said, that is the Fed's mandate, and their mental model, the way that they think about monetary policy is all about, keeping the genie in the bottle. The genie is inflation expectations. Like, it's okay if inflation is 4 or 5% for a little bit, if people assume, hey, this isn't really normal and it'll get back to where it was before. If people start assuming, as they did in the 1970s, that, hey, this is just the way it is now, and they start behaving accordingly, that is a societal problem, and the Fed recognizes that. And I think this is really interesting because, you mentioned Philip Jefferson. So Philip Jefferson is the vice chair of the Fed. So he's the number 2 guy behind Jay Powell. And he had a really interesting speech a month ago where he talks about uncertainty and how the Fed should create monetary policy around uncertainty and how to think about that. And I want to read a little bit from this speech just very briefly, because he couches it in these very scientific terms, but the implications are huge, right? So he says, quote, "There are circumstances when uncertainty might appropriately induce a gradual response, and other circumstances when a non-gradual response to uncertainty may be justified. One case of perennial interest to central bankers is inflation persistence, where the Bayesian approach, the ambiguity aversion approach, this is all the scientific mumbo jumbo, and its close cousin, robust control, I don't know what that is, all tend to lead to policy that is stronger than the certainty equivalent case to forestall the possibility of inflationary forces becoming embedded in inflation expectations. Another case is that of crisis periods." End quote. So what that means in plain English is, if we have uncertainty about how inflation expectations might become unhinged, what we have to do is we have to act drastically and bring out the giant hammer. And when he says another case is that of crisis periods, what he's referring to is in the post-COVID period when, I don't know if anyone remembers, but during the Fed meeting, the conference call, when the virus was raging, Jay Powell came out and basically said, look, this is a huge thing, and this is a huge uncertainty, and we're going to come out with all guns blazing, because the price of getting it wrong is enormous to society. And what he's saying is, on the other side, the door swings both ways. The uncertainty here is sufficiently high that if inflationary expectations become unhinged, this number that we just saw spike to 5.3%, if that becomes unhinged, in his words, it's a non-gradual response, which basically means clobbering everyone on top of the head with interest rates. And that's a big deal.
That is a big deal. Do you think Jerome feels that way? Like, how important is the number 2 saying this?
You can only speculate about that. But I think Jerome is bound by political considerations, of course, like anyone else. But I think this is so ingrained in the DNA of how the Fed thinks and talks, not just Jerome, but everyone. Inflation expectations, that's why they put in every statement. Inflation expectations appear to be well anchored. Inflation expectations appear to remain well anchored. It's the same statement every time. Why do they put that in? Because it's so central to their economic model of the world. So Jerome may need to be more circumspect than someone who's purely, an academic, than a Bernanke type of figure. But he cannot ignore this. This is something that's slapping everyone in the face. And if it's in, the popular discourse that people are already unhappy about inflation and consumer sentiment is down because of inflation, and it's affecting electoral outcomes because of inflation, it's very difficult to ignore that factor if suddenly things get worse.
Well, that was the second question I wanted to ask you, and I think we're going to get back to it at the end of the episode. But can the Fed hold off until November? Because I would imagine that the Fed doesn't want to be seen as being overtly political. But if they take out a sledgehammer between now and November, I mean, they're giving the election to Donald Trump, I think would be the way to put it. I don't think that's too much of a stretch. So do you think that they will try and hold off? Do you think that those political considerations just aren't there for the Fed, that it's now they're looking at the expectations, and if the data tells them what they're going to do, that's what they're going to do? It's hard to parse the relationship of politics and the Fed, but where do you go in that direction?
I mean, my guess is no better than anyone else's about what they're going to do or how bound they are by political considerations and not wanting to sway the election. So I don't know. I would assume they're not going to do anything between now and then. I think Marco is right when he says that about, all bets are off after November 5th, but until then you have a pretty good idea. But at the same time, I'm not sure how much it matters, because what matters is not so much the near-term rates. It's what everyone knows they're going to have to do if the data shifts. And presumably they've already started shifting the language. And I think this was a big deal in the last few months, where they came out and they said, effectively in the statement, they said, we're not making progress anymore. That was the narrative previously. Oh, we're making progress. Oh, it's bumpy progress. Sometimes, 2 steps forward, 1 step back. That has been thrown out the window. And in the last meeting, they said, we're not making any tangible progress. And that's concerning. So
it's almost like they're hoping that talking about the sledgehammer will mean that they don't have to use the sledgehammer, right? Like if they talk about, we might have to do this sudden thing, then maybe the market is going to correct itself based on the expectation, so that when the sledgehammer comes out, it's not quite as unexpected. But I don't know.
Yeah, I mean,
Teddy Roosevelt is rolling around in his grave somewhere.
No, but it's true, and it really is. It's like an infinite set of mirrors go back and forth, because yes, they will use language to try to set expectations, to try to increase long-term yields, or even decrease inflation expectations, to the extent they can, by just talking about stuff. That would be their preferred route, to just say, hey, just to let you know, Mr. Consumer, if inflation really got that high, we would come in with the sledgehammer. And okay, maybe it's not 6%, maybe it's 5%.
Yeah.
So it's a tricky game.
In a weird way, reminds me of China. Like their preferred way of conquering Taiwan would be that Taiwan just one day wakes up and they want to be part of mainland China, but maybe someday it won't go that way. All right, let's pivot into the third plank of the argument, which is in some ways the scariest, and really starts to intersect with the political question, because we've just been dancing around it on the edges here. But the inconvenient truth for the Fed, and this is also true of most governments, is that they don't control this shit. I was giving a presentation just yesterday to a dairy group, and one of the questions I got at the end of my presentation, because I was talking about rising protectionism and about how U.S. market access to different economies is, especially for agricultural commodities, is going to be affected by all the AI tariffs and protectionism and things like that. And somebody asked me, well, doesn't the U.S. government know that what they're doing is going to screw up access for milk to these markets? Like, don't they know this? Aren't they going to fix it? And I was like, you're giving them way too much credit, even if they do know it. The idea that they could control this this off the tracks train is a funny idea as well. So, what are you seeing that should really scare the Fed in the sense that it has nothing to do with interest rates, but other key fundamental points in the economy?
The big thing to be concerned about, and it's not to say that there aren't elements of inflation that are likely to decrease, because the Fed, interest rates do work for some things. But the problem is, for most of the things that are driving inflation right now, the Fed really can't do anything. And let's look at a few specific examples. So housing is the first one. As everyone has commented, like, oh, we thought housing inflation would go down a lot more than it has. And part of the reason why it hasn't is because the interest rate mechanism isn't working the way that the Fed and most people traditionally think that it should, which is, hey, interest rates go up, mortgage rates go up, demand goes down, price goes down. I mean, that's like economics 101. But really what's happening, and the numbers just came out about a week ago, is that existing home sales are drying up because no one wants to sell their home and roll into a significantly higher rate mortgage that they cannot afford. It's all about the monthly rate. So the months of supply of homes available on the market, even though it's somewhat improved from the very worst period, 2 years ago, is still well below pre-COVID levels. And the issue is that, there's just too much scarcity of homes to buy. And that's keeping home prices higher than they should be otherwise, and rents higher than they should be otherwise. So that's, one example. We talked about insurance, how, rising rates, paradoxically tends to increase insurance prices because there's less capital going into insurance, which means that prices tighten up. We won't go down that again, but that's another sort of example. But let's look at two others that are just completely outside of the Fed's control. And I want to focus on these because both of these, we've talked about this notion all the time of we're in a period of volatility and a period of cause and effect and cause and effect. And much of this sort of feeds on itself like an echo chamber, and the Fed doesn't control it. So let's look at freight, for instance, right? So freight prices are going up again. This is a very big deal. The most recent data show that import price inflation was up 0.9% month over month in the most recent month. That's a big jump. A big part of that is freight. Freight is getting up off the ground. Why is this interesting? So the freight market has been doing its own thing. And to a great extent, this is because of the post-COVID boom we experienced, which, you want to talk about unintended consequences and cause and effect. And the government, this isn't an anti-government thing. I think the government had to do what they did, but it has consequences that reverberate even today. So you have this post-COVID boom in e-commerce and consumer spending and everything durables. And what happened was you had a freight boom. So there was a massive boom for everything trucking and rail. And as a result, tons of people created new trucks and got into the trucking business because, hey, it's a boom. Let's all start trucking companies. And as a result, in 2023, you had a massive Great Depression in freight. So all of these trucking businesses like Yellow went bankrupt. Small truckers got out of the business. It was a huge hangover for freight as a result of the size of the boom. You had a huge hangover. And now what you're seeing is now that's coming back again in the opposite direction. The wave is bottomed and it's moving up because now you're having a normal inventory cycle. All the companies now who last year, as we talked about Williams-Sonoma, huge margin benefit from freight costs collapsing. That was, reflected in the last few quarters, 2023 into the beginning of 24. Now all the companies that didn't order inventory last year because they thought we were going into a big recession and ordered earlier than usual last year, the little stuff that they did order because they were terrified of supply chain disruptions. Now,
Terrified. Get it?
Now, if you look at the numbers this year, there's a boom in ordering. Orders are up a lot, and the orders are all happening in the traditional peak season. So someone in the industry was just quoted as saying that they're already seeing signs of sort of congestion in the rail network as we start to head, peak season for shipping for the holidays is like August. So there's already signs that the freight inflation that we've started to see trickle back in again is going to get worse in the back half of the year, even if the consumer demand slows down, as seems to be happening. And the Fed has nothing to do with that. Nothing at all. So the Fed could raise rates all day long, and that's not going to change any of those factors. These are the...
I also wonder if the uptick in if you look at the global level, if you look at the uptick in freight prices as a result of the Houthis continuing to shut down shipping through that part of the world. I mean, you've already got sort of supply chains that are not going back to the way that they were before, and which were elevated in price in response to the U.S. government not being able to control the Houthis. So you've got the U.S. government not able to control things in the Middle East, and the Fed not able to control things inflation-wise. But sorry, go on.
No, I mean, that's exactly it. And the other factor that I think is worth talking, so we talked about housing, we talked about freight, is food. So think of chicken wings, as we talked about. There was a boom in chicken wings post-COVID, which is kind of funny. But it's true. There was a massive boom in chicken wing prices in 2022. So if you want to see a proxy for this, look at the stock price of Tyson Foods, which is, the largest protein producer in the US. Their stock in 2022 was $90. It was up huge. They were raking it in. Chicken was killing it. Much like the freight market, you had a huge hangover in 2023. Tyson Foods stock went from 90 to 50, even, as other things were going up. So you had a similar sort of great chicken wing depression in 2023, and that's the same sort of thing for a lot of protein markets and food. And this was good for corporate profits, by the way, because anyone who's selling you chicken wings, the Chili's example, their chicken crispers, they've been making bank on the chicken crispers, but not for much longer, because now the hangover, much like freight, is done. And chicken prices are up like 33% year over year. So they're still below the boom period, but relative to last year, because the baseline is so low, you're seeing significant price inflation in food again, and in chicken particularly. So again, that has nothing to do with interest rates. It just has to do with the fact, just zooming back up to the top level again, that the Fed controls very little, the government controls very little. The notion that we are in an environment of high volatility and cause and effect, where it's like Newtonian physics, right? For every action, there's an equal and opposite reaction. Picture that, reverberating out across all these different stupid little markets that we follow, chicken wings and trucks and Williams and Sonoma cheese wheels. All of that is going in all sorts of directions, and the government doesn't control it. And I think that's the underlying takeaway, is when you look at the 10-year U.S. Treasury bond yields today, it sort of reflects the picture, the very tidy picture that Marco laid out, which I think is true at some level, which is, consumer demand is coming off the boil, and that should be, all else equal, pretty good for inflation. And the Fed has this kind of under control, and they're probably going to cut rates. And like the discussion is around these sort of narrow parameters and, what's their decision function? And we sort of understand this. That's risk. This is uncertainty. Uncertainty freaks people out when you realize, oh my God, Anakin Skywalker is not going to be the next Jedi. Things are much worse and out of control than we thought. We have to reset our whole baseline assumption for how the world works. And that is what's going to cause the 10-year Treasury yield to go to 7% at some point. That's my thesis here.
Yeah, we have to work on the metaphor because I'm not sure who is Anakin and who is the Emperor here in this metaphor. Um, and also, you talked about Tyson Foods. I don't think we can forget that the CFO of Tyson's Foods, what was that, last January? He did you hear about this? He drunkenly stumbled into like some stranger's house and like woke up in this woman's bed or something like that. So I think that might have something to do with the fact that despite all these good things, Tyson's has not been doing as well as you would think. The food thing is also interesting because I mean you're right. Like chicken had a big increase in price, and then everybody thought that we were going to be eating like so much chicken that they surged production, and then demand wasn't quite there. So then you had sort of a come down, which started to hurt them, and now things are coming back up. Um, I thought it was interesting. The U.S. Department of Agriculture is projecting that this year will be the first year that consumption of chicken in the U.S. will exceed 100 pounds per person. Uh, Pretty impressive when you think about it that way. But if you look at food prices in general, I mean, it actually sort of mirrors the current inflation story. Like if you're a farmer, or if you're like us, if you've been trying to trade wheat or some of these other commodities and you've been getting stopped out or burned by it, you might feel like the last year or two prices have been down, and they have been down relative to those 2021 and 2022 highs. But when you zoom out and sort of look back at the historical data, we're still at levels that we only touched in real terms around 2009, 2010, and 1974. So like there has been sort of slower growth the last year or two, but again, I don't think we're accepting the fact that we've gotten to a much higher level in general. And when you start putting together, man, I mean, the combination of weather things that are going on in the world, maybe some increased consumption from China. You remember everybody thought that the China reopening was going to stimulate consumption. Maybe it's not. Maybe China is just going to slowly get there on its own. I've been noticing that with coffee and some other markets in general too. So I don't know, a little bit hard to judge that. But I take the point that you're saying, which is that the Fed is in control of something that it can't control. It's sort of the worst possible job that you can have. And the reason I said that this really does intersect with politics is because I think the most skilled politicians, to your point, understand that their job is not to control the economy. This is why I was always confused about Biden and gasoline prices at the pump. Like if you're stuck in this loop where you are the one who is responsible for what you pay at the pump or what the person is paying at the grocery store, you're going to get burned eventually. What you need to be able to do as a politician is instill confidence and subdue fear. This is what FDR did at the height of the Great Depression. It wasn't that all of his policies, like, oh, he like threaded the needle from a policy perspective and fixed everything. He came out and said, the only thing to fear is fear itself. There are adults in the room now. We hear you. Things are going to be okay. We're going to take care of this. And I'm sort of struck by everything that you're saying and thinking, there is no U.S. political figure who is saying that right now. Like we're in the depths of an election where everybody hates both of the candidates. The candidates hate each other. The radicals on both ends like think the others are fascists. There's no candidate who's going to come in and stabilize sentiment. So if you're looking for sort of a political, I think that's one of the things that political leadership is supposed to do in this type of scenario, where it can come in and it can rehinge the expectations, or it can tell people not to be afraid. And it's why I think your metaphor about inflation expectations unhinged. It's because everything's unhinged. I don't think people like feel confident in the things that they're thinking about or experiencing in their daily lives right now. And I think you can see that in the economy. I think you can see that with politics and just about everything else.
Yeah, or if you want to think of it quantitatively, volatility clusters is another way of saying what you just said. And, whether you're looking at financial markets or whether you're looking at societies, volatility and crazy times tend to lead to crazier times. Because, if you think of a stock market bubble, it's not your typical thing where the market's going up a little bit and down a little bit every day and you don't really pay too much attention. It's, oh my God, everyone is focused on it. It's going up 3% and down 7% and up 8%. I mean, the same thing goes for societal outcomes, as you say. Like we had, literally one of the most traumatic experiences in American history and then one of the most glorious, incredible bubbles within 2 years of each other. Like, that's not a coincidence. That's cause and effect and volatility clustering. And it's like things aren't calming down, as you say. It's the opposite of calm. Things are getting less calm. And I think that's, that's predictable because volatility clusters. And the question is, how do you, as someone who's managing wealth or capital or just yourself and your family and thinking about how to expect what's coming around the bend, how do you take that into account in your expectations and realize, like, what is your proper baseline expectation of what could truly happen?
It's why I'm unconvinced that we've seen even the end or even the height of the YOLO economy. That was the one thing, and when I was talking with Marco, which, as I've thought about it more, like I think part of the YOLO economy is exactly what we're talking about, where people are so uncertain and they're just like, let's go for it, like let's live more life. And like I say this on Twitter all the time. I joke about it here on the podcast. Like, I travel so much for work. Like, the airports are packed. I was looking at vacations on the beach because my wife and daughter and I were going to go on a beach vacation in a couple weeks. It's packed. The prices are insane and everybody's there. So I don't see any evidence at all that the YOLO economy is going away. And it seems like anytime anybody gets a couple dollars in their back pocket, or like they pay off a little bit of credit card debt, just put on some more credit card debt. Or if the credit card limit gets raised, good, let's go on a vacation. We're not sort of thinking about tomorrow. Maybe last thing, Rob, like if somebody is listening to this and came to you and said, I agree with you, volatility clusters and everything else, that's why you should just buy and hold. That's why I don't think about activist investing and things like that. I just buy things and I hold them for 10 or 15 years, and that's the way that I do it. What do you think of that approach, and how would you respond to somebody who would take that approach to the volatility clusters that we're talking about here?
There's a lot to go into with that, but here are a few quick hits. Buy and hold presumably means buy a stock market index, if that's what you mean. Hey, I'll just buy the S&P 500. There are a number of problems with that. The first is, inevitably someone is going to buy it when it's a period like now, when you shouldn't be buying it, quite frankly. It's a period of euphoria. So when volatility clusters, it's very difficult to have the discipline to buy at the bottom of the volatility, at the bottom of the curve and not at the top of the curve. So that alone is working against you. The second is, if you look within stock market returns, so look at the last generation, we've talked about this, 60% of all stocks in the prior generation, from 1990 to 2020, 60% of all stocks destroyed your money because of creative destruction, even within a period of huge prosperity. That is going to be higher, not lower, in the future, because volatility clusters mean there's more change, more things happen more quickly. Like, we can see this. There's good elements of this too. There's creative destruction. Think of all the businesses, all the value that's going to be destroyed by AI, just to take one example. The third thing I would note is the current sort of leaders of the index. Everyone's familiar with the idea that the S&P 500 is basically dominated by 6 or 7 companies that are huge. They are the beneficiaries of a non-volatility spiral environment. And now things are changing a lot. And they're trying to adapt and react to the change. But the notion that you're going to have this stagnant, group of monopolists who are going to be the leaders for the next 20 years, that were also the leaders of the last 20 years in a volatility spiral, good luck with that. Ain't going to happen. It's never happened historically, and it's not going to happen during a period when there's such drastic change. And we can talk about this because I want to talk about AI in particular on a future episode, and all the disruption and opportunities within there. It's very exciting and short. But for all of these reasons, even more than usual, it doesn't make sense to just buy and hold. you'll see your money eroded away over time.
So on that rosy note, anything else you want to tell the listeners before we get out of here? You want to go back to the defenestration of Prague?
Oh, I know. Why don't we bring in the 30 Years' War? Because this is dark enough as it is.
Well, no, it's actually not dark. I thought what you ended on was exactly right, and it was why I brought up the metaphor of the real wages thing versus inflation expectations. Because as you said, like, this is the time of tremendous opportunity. If you can identify the 30% or the 20% that are going to create value, you're going to do incredible. And it's not every person gets to live through a period of this kind of incredible stepwise change. So, like, most human beings don't like volatility. Like, we're literally, like, evolutionary predisposed to not like things to be volatile, because usually volatility leads to bad outcomes. But we've overcome that to a certain extent with the things that we've done as a species. Like, having volatility doesn't mean you're going to get eaten by a lion in the middle of the savannah anymore, right? It means, like, you lost some money on an investment or something like that. So I think the key positive point that we're talking about here, and even the sort of entire frame of this podcast, which is, inflation expectations are unhinged. The Fed says it might take out a sledgehammer, but the Fed is not in control. Great. We're telling you that because that's an opportunity. We're not telling you that to depress you and to force you to put all of your money under the mattress. We're telling you that because if you can get out of the groupthink here and think about, okay, well, how do I position myself sort of appropriately or hedge my risks if what these guys are talking about, maybe it's not the most likely scenario, but maybe it's a real scenario and maybe it's increasing in likelihood. How do I hedge my risks and things like that? So we're talking about the scary, but I don't think either one of us, I'll at least speak for myself here, I'm not scared. I'm still excited by everything that I see around me. The only thing that scares me is again, a presentation I did yesterday. I started off with a picture of Brazil, Porto Alegre, and then I had a picture of the heat waves in Vietnam and the Philippines, and then a picture of Houston storms last week. Like, that's the sort of stuff that scares me. And by the way, like, the input of climate change as a volatility sort of boost for inflation or higher prices and all these other things, we haven't even talked about that, which also comes with its own risks and opportunities and things like that. Anyway, point being,
just one final thought on that, just to close out. I think the good analogy you mentioned, Franklin Roosevelt, and think of the Dust Bowl as the climate change of the time. A good analogy is that first 30 years to 40 years of the 20th century, because it was a period of incredibly that was a volatility spiral, and it didn't have a circuit breaker until we almost blew ourselves up in World War II. But underneath that dark side was the most amazing period of creativity and progress and technological revolutions that created untold wealth that basically put us in the modern world that we experience today. And that, I think, is the blueprint to think about this. Is stagnation is out, and there's the double-sided, creative destruction that's, by definition, a Janus-based term. So anyway, I think you're right. I tend to be playing up the gloomy because that's fun to talk about, but it's the same, token. It's incredible opportunity and incredible change for good.
Yeah, I mean, even if Darth Fed brings balance to the Force, the Jedi didn't get annihilated. You want to be on the side of the Jedi. Or maybe, I don't know, maybe the Emperor made more money in the military-industrial complex. I don't know, but that'll have to be an episode for another time. Thank you so much for listening to the Cognitive Dissidents podcast, brought to you by Cognitive Investments. If you are interested in learning more about cognitive investments, you can check us out online at cognitive.investments. That's cognitive.investments. You can also write to me directly if you want at jacob@cognitive.investments. Cheers, and we'll see you out there. The views expressed in this commentary are subject to change based on market and other conditions. This podcast may contain certain statements that may be deemed forward-looking statements. Please note that any such statements are not guarantees of any future performance, and actual results or developments may differ materially from those projected. Any projections, market outlooks, or estimates are based upon certain assumptions and should not be construed as indicative of actual events that will occur. Cognitive Investments LLC is a registered investment advisor. Advisory services are only offered to clients or prospective clients where Cognitive and its representatives are properly licensed or exempt from licensure. For additional information, please visit our website at www.cognitive.investments. The information provided is for educational and informational purposes only and does not constitute investment advice, and it should not be relied on as such. It should not be considered a solicitation to buy or an offer to sell a security. It does not take into account any investor's particular investment objectives, strategies, tax status, or investment horizon. You should consult your attorney or tax advisor.